Your great financial advisor is here, and in today's tutorial I'm going to be talking about capital allowances versus depreciation treatment for tax purposes. From an accounting perspective, depreciation is allowed in the profit and loss account, but it is a non-tax item. So what happens to those assets that are allowed for depreciation in the profit and loss? How are they supposed to be treated for tax purposes? This is where capital allowance come into play. Depreciation, we have three methods: the straight line, reducing balance, and the book value method. Then capital allowances, they are in two parts. We have the special initial allowance and wear and tear. Special initial allowance is allowed on immovable assets that are constructed or purchased, while wear and tear is on movable assets, even on immovable where there is no election. Because SEER is based on election, you have to elect for SEER. So, taking for example a sole trader, a person in consultant business with a laptop, which is the main asset used for business, how is the laptop supposed to be treated for tax purposes? Taking example, it's a Dell laptop worth $3,000. If under depreciation in the profit and loss account, it's supposed to be allowed in the profit and loss. When we come to computation of taxable income, we add back the depreciation. We say net profit, add back depreciation for us to arrive at the taxable income. Then we allow for capital allowances. Laptops, the rate of wear and tear for laptops is 25%. So it will be the 25% on cost in the first year if the asset is wholly used for business. In the event that it is partly used for business and partly private, there is need for apportionment. The percentage for business is then allowed as wear and tear. In our case, assuming that it's wholly used for business, then we say 25% of 3,000. It's 750. That's the wear and tear that is supposed to be allowed before we apply the tax rate to our taxable income. Then the following year, the rate will be on the income tax value, which is the written down value. 3,000 less 750 in the first year. End of first year to be 2,250. So second year it will be 25% of 2,250. That's how we calculate for the wear and tear for tax purposes. Thank you.